Who I am and why I'm talking to you, my name is Jack Bogle. I spent my entire life in the world of investing, and I watched countless investors lose money not because the market was cruel, but because they made things unnecessarily complicated. I helped launch low-cost index funds and saw millions of ordinary people achieve better results than highly paid fund managers simply by embracing simplicity. Today, I want to talk to you about one simple portfolio that can beat 90% of investors if you truly understand it, apply it, and stay with it over time. Chapter 1. Why most investors lose. Most investors do not lose because they are stupid. They lose because of behavior, fear when markets fall, greed when markets rise, and a constant urge to chase headlines and hot tips. Many try to time the market or pick the next winning stock, even though decades of research show that most active fund managers fail to beat the market after fees over the long term. The problem is not only bad choices, it is also the silent killers. High fees, taxes, and excessive trading, all eating away at your annual return year after year. Chapter 2. The philosophy behind the simple portfolio. The core idea is simple. Instead of trying to beat the market, own the whole market at very low cost, and let the power of compounding do the heavy lifting over decades. This is the spirit behind the famous three-fund portfolio, loved by the bogleheads community. One broad domestic stock fund, one broad international stock fund, and one broad bond fund. With this approach, you become a partner in thousands of companies around the world, plus a share of the bond market, without having to analyze a single individual stock or pay high active management fees. Chapter 3. The building blocks of the portfolio that beats 90% of investors. Let's translate the philosophy into actual building blocks. One total domestic stock market index fund that covers your home market as broadly as possible. One total international stock market index fund that gives you exposure to companies outside your home country. One total bond market index fund that provides income and stability. In the United States, the classic example is a total U.S. stock market fund, a total international stock market fund, and a total U.S. bond market fund. The same structure can be replicated in most countries using local ETFs or index funds. This combination is often called a lazy portfolio, but in reality, it is very smart. It admits that humans are bad at prediction and instead bets on the long-term growth of the entire market. Chapter 4, how to allocate your money inside this portfolio. Your split between stocks and bonds depends mainly on two things: your age and your ability to tolerate volatility. A common rule of thumb is that younger investors with a long time horizon can hold more in stocks, while those closer to retirement should hold more in bonds for stability. Here are rough examples, not rigid rules. A young investor might hold 70% in stocks, domestic plus international, and 30% in bonds. A mid-career investor might choose around 60% stocks and 40% bonds. Someone close to retirement might prefer 40% stocks and 60% bonds, or even less in stocks. Chapter 5. Why the simple portfolio outperforms most investors. First, costs. When you invest through low-cost index funds, you keep most of your return instead of handing it over to managers and intermediaries. Over decades, this cost advantage becomes enormous. Second, diversification. By owning broad stock and bond index funds, you dramatically reduce the risk of any single stock, sector, or country ruining your financial future. Third, discipline and simplicity. Because there is no stock picking or market timing, you are less tempted to make emotional decisions. You simply follow your plan and allow time to work in your favor. Chapter 6. What the research says about lazy portfolios. Studies and long-term backtests show that simple, lazy portfolios are designed to perform well across many different market environments with minimal intervention. Over long periods, many of these portfolios have matched or beaten the results of most actively managed portfolios after fees and taxes. This is not magic. It is the natural outcome of low-cost, broad diversification and a steadfast long-term mindset. Chapter 7. What exactly is the three-fund portfolio? The three-fund portfolio is a specific version of this simple approach. One total domestic stock market index fund, one total international stock market index fund, and one total bond market index fund. This design gives you extremely broad exposure to global stocks and domestic bonds with the smallest possible number of funds and very low ongoing costs. Investors all over the world have adopted this structure, adjusting the percentages to suit their own situations, and many have found it more than enough to build long-term wealth. Chapter 8, Step by Step, How to Build This Portfolio. Step 1, Define your plan. How much can you invest each month? What is your time horizon? How much volatility can you realistically tolerate without panicking? Your answers determine your stock-bond split. Step 2, choose suitable low-cost index funds or ETFs in your country that match the three building blocks: domestic stocks, international stocks, and bonds. Step 3, set target percentages for each fund and invest automatically every month according to those targets, regardless of what the market is doing. Chapter 9, Rebalancing, the small secret of simple portfolios. Over time, some parts of your portfolio will rise faster than others. Your allocation will drift away from your original target. That is when rebalancing comes in. Rebalancing once a year or on a fixed schedule simply means selling a bit of what has grown too much and buying more of what has lagged, bringing you back to your chosen percentages. This keeps your risk level consistent and forces you gently and automatically to buy low and sell high, instead of doing the opposite in moments of emotion. Chapter 10, Why People Ignore This Simple Advice. Human beings love exciting stories. They want the thrill of discovering the next big winner, not the quiet, boring discipline of owning the entire market. Financial media survives on drama. Simple, boring portfolios do not generate clicks and ratings, but crises, bubbles, and bold predictions do. The financial industry often profits from complexity. The more complex the product, the easier it is to hide high fees, and the harder it is for the average investor to see what they are really paying. Chapter 11, How Emotions Destroy Investment Returns. In bear markets, fear drives investors to sell at the worst possible moment, turning temporary declines into permanent losses. In booming markets, greed convinces them that this time is different, pushing them to take excessive risk and chase what has already gone up too far, too fast. The simple portfolio is driven by rules, not emotions, regular contributions, periodic rebalancing, and a commitment to stay the course through both good times and bad. Chapter 12, A Quick Comparison with Other Strategies. Active stock picking and market timing aim to beat the index. A few professionals may succeed for a while, but the evidence shows that most do not outperform broad index funds after costs over the long term. Short-term trading raises costs, taxes, and stress. It almost guarantees that emotions will override logic at critical turning points. The simple portfolio accepts a powerful truth. Capturing the full market return at low cost is usually better than chasing outperformance and ending up behind like most investors. Chapter 13, How This Portfolio Adapts as Your Life Changes. As you get older, you do not need to reinvent your strategy. You can adjust your stock-bond mix gradually, increasing bonds and reducing stocks to lower volatility and secure more stable income. As your income grows, you can increase the amount you invest each month into the same three funds without changing the core design of your portfolio. When markets go through crises, you still do not need a new strategy. You simply review your allocation, rebalance if necessary, and continue your regular contributions. Chapter 14, The Risks of This Simple Portfolio. No strategy is risk-free. Even a well-diversified, low-cost portfolio will experience sharp temporary declines during major market downturns. The greatest risk is not in the funds themselves, but in your behavior. If you abandon your plan at the worst moment, you will miss the recovery that historically follows bear markets. There are also risks tied to currencies, local economies, and global conditions. Diversification cannot eliminate these completely, but it can reduce the impact compared to concentrated bets on single stocks or sectors. Chapter 15, when this portfolio might not be right for you. If you are seeking constant excitement and the feeling of beating the market every week, this portfolio will not satisfy your emotional needs, even if it serves your financial interests. If you need your money in a very short time, broad stock market exposure, even through index funds, may not be appropriate because of volatility. If you are unwilling to commit for many years and unwilling to change your behavior around money, then the problem is not the portfolio. The problem is the discipline required to let it work. Chapter 16, dealing with the noise of the media. You will constantly hear confident predictions. Some claim the market is about to crash. Others promise a new era of endless growth. They cannot all be right. Most of these voices do not care about your personal plan or your time horizon. They are focused on attention, not on your long-term results. Your best defense is a simple, evidence-based strategy that you understand and trust, combined with a firm decision not to let daily news dictate your long-term plan. Chapter 17, The Power of Basic Financial Education. Understanding a few core concepts, diversification, compounding, fees, and taxes, is far more important than knowing the names of complex products or tracking markets every day. Once you realize that a 1% difference in annual fees can mean hundreds of thousands of dollars over a lifetime, you become fiercely protective of your costs. The simple portfolio is not just a group of funds. It is a practical expression of a philosophy. Learn the basics, cut the noise, and let time and discipline do the work. Chapter 18, Concrete Steps You Can Take Today. Sit down, alone or with an independent advisor, and write down your goals, your time horizon, your risk tolerance, and the amount you can invest regularly. Clarity comes before action. Search for low-cost index funds or ETFs in your market that match the three essential components: domestic stocks, international stocks, and bonds. Create a simple written plan that specifies your target percentages, your monthly contribution, and how often you will rebalance. Then commit to following that plan through all market conditions. Conclusion, a personal message from Jack Bogle. Throughout my career, I have seen that ordinary investors can achieve extraordinary results if they reject the illusion of prediction and embrace simplicity and discipline instead. The simple portfolio that beats 90% of investors is not a secret formula. It is a mix of broad index funds, low cost, regular investing, and the courage to stay the course when others are losing theirs. And if you remember only one thing from this message, let it be this: you do not need to be a genius to succeed in investing. You need a good, simple plan and the patience and character to stick with it when everyone around you is changing theirs.